very, very happy to have Professor Shang-Jin WEI from Columbia University to talk to us about FinTech as a financial liberator. And I will give a very short introduction of Professor WEI. I have a very long list here, so I will be very short. Professor WEI is currently at Columbia Business School, as well as a SIPA of Columbia University. And his research is mostly on international finance, trade, macroeconomics, and China. He has been involved in many important activities of IMF, and he was the assistant director and the chief of trade and investment division at IMF. And he was also the chief economist of the Asian Development Bank and director general of its economic research and regional cooperation department. So I have known Shang-Jin for many years, and he has many influential papers, many publications, many awards, and I will not go down the list. So please go ahead, Professor WEI, you have 25 minutes.
Thank you very much, Professor Zhang, for your generous introduction. Good morning, everyone, friends and colleagues in Asia. Good evening, friends and colleagues in North America. So the title of my presentation is FinTech as a Financial Liberator. This is a joint work with Greg BUCHAK of Stanford University and Jiayin at Peking University. The phrase financial liberator is a reference to the expression financial repression, which is a common phenomenon in developing countries, referring to interest rates deviating from market interest rates. So one particular dimension of financial repression is that interest rates on household savings to be substantially below free market determined interest rates, a phenomenon first made well known by McKinnon and Shaw, and then by subsequent literature, including by Rubini and Sly Martin. Financial repression or having artificially low interest rate on household deposits is a form of a tax on households, but it is a benefit to the banks since it lowers the cost of capital. So it's a way for financial system to extract tax on households to do whatever the government might think is useful to do. China had financial repression throughout much of its PRC's economic history until late 2015. So late 15, so was only essentially removed relatively recently. The research question in this project is the role of FinTech in helping to remove this particular form of financial repression. And the particular FinTech product we're going to be talking about is Yuebao, a FinTech enabled money market fund. Here's a graph that provides some basic background information for this project. On this graph, I plot several different kinds of interest rates. The solid black line at the bottom is the ceiling or the maximum permissible interest rate on bank demand deposits, from beginning of 2000 all the way to 2012. One way to see this is very low is to compare that with other interest rates. On the same graph, the light broken blue lines traces out 3-month SHIBOR rates, which we think is a proxy for what the market interest rate would be in the absence of regulation, in the absence of ceiling. And this assertion is supported by my next two statements. So on the same graph, you see a vertical line corresponding to the month of June in 2013. So if you can see my cursor, so the vertical line is the date on which Yuebao money market fund was introduced by M Financial. and the interest rate on Yuebao is the solid red line. So solid red line is the interest rate that once Yuebao is introduced, it's the interest rate the household can actually get. And the thing you get, one feature you can observe is that this solid red line, or the Yuebao interest rate, is essentially the same as the 3-month Shabo rate. So once Yuebao is introduced, Yuebao pays interest rate that's essentially the same as a 3-month Shabo rate. For that reason, we can think about the Shabo rate even before Yuebao was introduced was the free market interest rate that would have been available to household if there were no demand deposit ceiling. So again, so our project is to understand, the role of a fintech in introducing Chinese households to a market-determined interest rate, which is substantially above what they used to get. Essentially we do two things. So the first thing is that a combination of a pay tech, our digital payment technology, together with a money market fund that pays market interest rates, maybe together also with the reputation of a big tech, creates a viable substitute for banks' demand deposits. And once that's available, if banks do nothing, this will lead to deposit outflows that will put pressure on banks, which show evidence that banks loss of deposits can be traced to individual banks' exposure to fintech. We're going to talk about our way to construct the bank-to-bank variation, the exposure to fintech. But we're going to show evidence that banks' loss of deposits can be linked to the fintech exposure. And then we show that banks, of course, would do something in response to that. And banks' response includes rolling out their own products that pay market interest rates. So banks do this to protect their funding source, trying to compete with fintech. So fintech cannot get all the money from the banks. In the end, fintech get a relatively small portion of the money from the banking system. Nonetheless, because banks have to respond, and banks' response essentially means the end of financial repression, because from that point onwards, households now get to enjoy market interest rates. So that's going to be, a big part of our story. But then we could do also, given that the bank now have to experience higher cost of capital, one possible concern we might have, this is a great, wonderful thing for the households, but could this present, could this raise the banking sector instability? Could this raise the riskiness of a bank's lending portfolio, for example? So we're trying to look into that, and we do not find robust evidence suggesting that bank assets have become significantly riskier. So therefore, so far, the evidence we see does not support the idea that this particular financial liberalization leads to more risks in the financial system. So that's the summary. So on this slide, I have a set of a literature that we can refer to, but given the time, I'm going to skip the literature review. There's some literature on how banks and fintech compete with each other, but I will note that as far as we know, we have not seen paper that points to this removal of financial repression story associated with the fintech. So that's our contribution. So some background information about the Chinese banking sector, which probably is well known to everyone on this at the panel and on this audience, but it's useful to remind us some salient features. Number one, Chinese banking industry is very concentrated. Top 5, top 6 banks have a huge market share in lending and deposits. But equally important, China has 300 or so banks. Many banks in fact, are regionally very concentrated. Many of the banks have most of their branches in a single province, sometimes in a single city. So there's also regional specialization of banks, which offers a way to see potential variation in exposure to this fintech product in the early stage of the fintech products. The second feature is the depressed deposit interest rate that we already show by a graph, that interest rate is face a ceiling, and the ceiling is very binding. It's substantially below what market interest rate would have been, number one. And number two, I want to point out, banks don't have a strong incentive to remove the ceiling on their own, because the ceiling is good for the bank. Not only it reduces cost of capital, but it's also a coordination device that the banks can feel comfortable that other banks will not try to undercut them by raising their individual interest rates. Lastly, banks are also politically powerful. Executives of large banks tend to be quasi-officials, and many financial regulators are former bank officials. So banks also have a special role in the entire regulatory apparatus. That's the background information. Okay, now let me give you a background information about the Yuebao product. Again, I assume many people are familiar with, but the feature that are especially important for our project are the following. The following three features are especially important. One is Yuebao offers T+0 unlimited, no fee redemption, a feature not available to Chinese households in anything other than demand deposit. Demand deposit is the only thing that offers T+0 no fee redemption. Except it's very troublesome. You have to go to a bank. You do have to do something to do this. But demand deposits offer this. There's virtually no minimum investment, or technically the minimum investment is 1 RMB. In contrast, before Yuebao was introduced, some banks offer some wealth management products, which ask for a very high minimum investment. It has a very high minimum investment threshold, which make those products essentially not very, not accessible to most households. It's only accessible to relatively wealthy households. And finally, because it's bundled with Alipay, the Yuebao money market fund pays market interest rates, but also allows a very convenient, conversion into something. You can essentially buy products online, do online shopping almost directly, instantaneously, from redeeming your money market fund shares. So the combination of the paytech and the money market funds offers convenience that's not rivaled by anything other than demand deposits. Importantly, it offers market determined interest rates that demand deposits do not. So in that sense, Yuebao essentially presents the very first really viable alternative to demand deposits. I want to note that before Yuebao was introduced, most Chinese households had no exposure to money market fund. In fact, had no exposure to mutual fund products, even though mutual fund company have been around for a while by then, by 2013, but that's not something that the most Chinese households had much exposure to. Here's a picture that shows the growth of Chinese money market fund industries. So the vertical line, June 2013, again, it's the date when Yuebao was first introduced. So before that, there were money market funds, but essentially a very small number of households would have exposure to that. And most of the growth of money market funds came after the introduction of Yuebao. We're going to suggest there's a causal story there from Yuebao to general household investment in money market funds. Okay, so we're going to make a combination of data on the spread of Yuebao by city and month, penetration of Alipay by city and month, both come from and the group. And we're going to use hand-collected data on what we call about type products. So these are products offered by banks that pay market interest rates. They offer T+0 redemptions. And then we have other variables, essentially will be control variables in our regressions. We're going to use combination of this. Let me skip this. Most of our specifications will be variations of this, very simple cross-sectional regressions. So I want to take a minute just to explain our specifications. So most of our regression can be done across cities, across banks. For today's talk, I'm going to focus on results across banks. So there will be essentially of a following type. We're going to regress some outcome variable on expose. So let's say on this particular slide, I talk about city level regression. The same explanation will apply to bank level regression. So we have city level outcome variables on the left-hand side, and then we have city level exposure to Yuebao penetration as the key variable, and there will be a set of control variables. Our dependent variables, we're going to look at two key dependent variables in the first part of the talk. One is fund flows into Yuebao, either city by city or bank by bank. Just for clarification for maybe a small fraction of people who are not as familiar about Yuebao, is assuming, so Yuebao itself is not money market fund. The money market fund is called Tianhong money market fund. The Tianhong money market fund is essentially tied to Yuebao. So without loss of generosity, I'm going to treat them as equivalent for the purpose of this talk. So one outcome variable will be cumulative flow into Tianhong fund or Yuebao money market fund from June 2013, the month in which Yuebao was introduced, to May 2014, a year later. There will be one dependent variable, and the other dependent variable will be change in various type of a deposit from end of 2012, before Yuebao was introduced, to end of 2014, the first year after Yuebao was introduced. We're going to look at growth of deposits of various types, from demand deposits to other deposits to corporate deposits. The story about the Yuebao is about Yuebao as a competitor for demand deposits. So our intuition will say Yuebao should have especially big effect on demand deposits, perhaps will not have much effect on other kind of deposits. It will not have the same kind of effect on time deposits. It should not have much effect on corporate deposits, since it's not designed to compete with corporate deposits. So you can think about the demand deposits is the effect we want to estimate. The other kind of deposit growth is like a perceivable test. Now, one might worry about the possible endogeneity of this Yuebao exposure. In particular, suppose you see a correlation. Suppose you see in cities or in cities where there's a high Yuebao penetration, you see negative growth of demand deposits. That kind of correlation, in principle, could be driven by different kind of stories. So suppose FinTech plays no role in loss of deposits by banks. Simply that people in some cities decided to explore money market funds. They look for a way to invest in money market funds, and Yuebao happened to provide a way to do it. So you see a correlation between Yuebao penetration and loss of deposits, but the causality may not go from FinTech to deposit, but going from some other things that trigger people want to look for a way to invest in money market fund. So for that kind of concern, we suggest a instrumental variable approach. In fact, we suggest two different ways to construct instrument. One is to look at the either city level or bank level exposure to Alipay penetration. So Alipay technology was available 1 decade before Yuebao, so it's predetermined, way predetermined. Since Yuebao is so through Alipay, it's natural to expect that places with greater Alipay penetration very likely will give you more Yuebao exposure as well. Indeed, data suggests extremely strong association between the two. The second instrumental variable is at the city level is the city's distance to Hangzhou. The idea, and this is being used in, I think, Xiaoyan's paper too, right? So the other people paper too. The idea is that when M Financial needs to roll out a service, it needs to talk to vendors, convert vendors, place by region by region. You cannot do it just due to cost constraint. You cannot roll out this in all places overnight. So this logistic need to convert people batch by batch was suggest the possibility that the places closer to M Financial's headquarters gets treated first. A hypothesis that one can verify in data. Indeed, the data suggests that's indeed the case. Okay, so both first stage regression suggests that the Yuebao penetration is indeed very highly correlated with Alipay penetration, and very highly, strongly negatively associated with distance to Hangzhou. So these are variations at the city level. I'm gonna report the regressions at the bank level. At the bank level, so let me just explain in words, how would one convert city level variation into bank level variation? And the idea is to explore that.
Shang-Jin,
yes.
5 minutes.
5 minutes only. Wow. So I need to let's see, how do I do this? Okay. Let me do this. So because different banks can have branches in different cities, so therefore one can use that information, bank branch location information. One can convert city level variation in exposure to Yuebao or exposure to any of the two IVs into bank level exposure. So on this slide, so I'm going to run through a few key results. On this slide, we look at where the funds flow into Tianhong or Yuebao funds from the time when Yuebao was introduced to a year later. Is related to bank level exposure to Yuebao? The answer is yes, and very strongly that those banks with branches in places with a lot of exposure to Yuebao tend to see more money flow into Tianhong fund or Yuebao fund. Same logic would explain the next slide, which is that if you look at the bank level growth of personal household deposits, you will find that those banks that are more exposed to Yuebao competition tend to see relatively greater loss of personal deposits over time, in the first year after Yuebao was introduced. In comparison, we don't see similar pattern for corporate deposits. Corporate deposits can be considered as a placebo, since Yuebao is not designed to compete with corporate deposits. Even within personal deposits, if we split the household deposits into demand deposits versus time deposits, we'll see that even though both give you a negative coefficient, you see significant loss of demand deposits for banks with greater exposure to Yuebao, but you don't see equally significant result for time deposits, confirming the idea that Yuebao is a greater substitute for demand deposits, except that it pays market interest rate and it's more convenient for online shopping and so on. And then so on this slide, we show about type products, meaning other products offered by banks that pay market interest rates offer T+0 redemptions. They essentially all come after yuebao was introduced. And we're going to argue, we're going to use statistical method to argue that this is not coincidental, that this can be causally traced to the competition from yuebao. For example, on this slide, we report the linear probability model that shows that banks with greater exposure to yuebao competition after controlling for bank size and other features of the banks tend to introduce their own market interest rate kind of products within first year after yuebao was introduced. The next regression is a hazard model that shows the probability for a given bank to introduce bao type product rises with exposure to yuebao. So I skip those. The last thing I want to discuss about the effect on bank balance sheets. Is this okay? So yuebao seems to have succeeded not only by paying market interest rate themselves, but importantly by inducing banks to start to paying market interest rates on household savings. So that spells the end of a financial repression of this type for households. Great news for households. But what does that do to the banks? So that's the last thing I want to say. Ex ante, of course, one can imagine, this could be a source of concern if yuebao competition leads to banks losing money and then getting into very, very risky activities. But we actually do not find much evidence for this. So here I sort of cherry pick one place where you can see some negative effect from yuebao exposure to banks' core profits. But this is like after searching for 20 different kind of variables. For most other variables, including net interest income and others, you do not see significant effects of yuebao exposure on bank balance sheet. For example, on this slide, when we look at bad loan ratio, changing bad loan ratio from the year before yuebao to a year and a half after yuebao, we found zero correlation across banks. So your banks have different variation, different exposure to yuebao, but those variations does not predict how well banks do in terms of bad loan ratio. Column 5 to 8 look at share of risky assets in banks' overall assets, and we do not find evidence suggesting greater exposure to yuebao lead to an increase in risky deposits. If anything, the regression coefficient seems to suggest that we see a decline in risky assets as a share of total deposits. So let me conclude and summarize. We suggest that the combination of a fintech technology together with a market interest rate product money market fund collectively help to generate a bottom-up interest rate liberalization, helping the country to essentially end financial repression on household savings. And the channel for the end of the financial repression partly go through banks' response to fintech competition, and banks' response includes banks offering their own products paying market interest rates. And finally, we're looking to whether this kind of competition exposes banks themselves to riskier lending behavior, and so far we have not found evidence supporting that. So that's my report. Thank you very much.
Okay, thank you, Shang-Jin. Now we're gonna move on. Thank you for the excellent presentation. Now we're gonna move on the discussion by Professor Yiping. So let me also introduce Professor Huang a little bit. Professor Huang is now a chair professor at Peking University. He's also the deputy dean of the National School of Development and director of Institute of Digital Finance. Professor Huang presented a paper like a few weeks before, but so I also need to mention that he was the member of the Monetary Policy Committee at the PBOC in the past few years, and he is a member of the External Advisory Group on surveillance and IMF. And again, like Professor Wei, Professor Huang has a very long CV and he has many publications and awards. You guys should go check his website. So without further ado, Professor Huang, oh, you already shared your screen. Please start. You have 25 minutes.
Okay, thank you very much, Jiayin. And I also like to thank the organizers for inviting me to discuss this very exciting paper by Shang-Jin and his colleagues. Jiayin, in fact, is a colleague of mine at the school. So we had a bit exchange about this idea. I thought it was quite exciting. So just let me restart the question. The question the paper examines is basically an alternate pathway for financial liberalization in the context of China, especially bottom-up liberalization driven by financial innovation outside the repressive regulatory framework. The key question, as we just heard, was really about money market fund of Yuebao, which helps to remove the deposit ceiling regulation in the banking sector, offers new kind of more market-oriented financial products to depositors, to households. The main findings are really, this is just the final page of Shang-Jin's slides, so I'm not going to get into it. These are the three key takeaways from Shang-Jin's paper. First, my very general impression, I think it's a very insightful and enlightening paper with a very powerful message. FinTech could be an important force of financial liberalization, but it's a bottom-up financial liberalization. In some sense, this kind of what sometimes I call backdoor liberalization of interest rate is always happening in China. And one example is the curb market, the informal lending, which always exists. And the reason why it exists is because the regulated bank interest rate sometimes do not do the job, for whether for the depositors or investors or for the borrowers, because the lending rate is so low, you're not going to satisfy demand for some specific customers. So here, another example is the shadow banking businesses. And one of the reasons why the shadow banking business is happening, and people always say, well, the motivation for shadow banking is to bypass the regulation. This is what usually understood universally, including in the US. The case in China is slightly different. Number one, when we say shadow banking in China, people always say it's a shadow of a bank. Really, it's conducted by banks themselves. And what they're trying to do is just to move the businesses out of the balance sheet. So bypassing regulation is an important part of the story. But the other part of the story is also to bypass repressive financial policies, so restrictions on interest rate and so on. In a previous study, the former CSRC chairman Xiaogang did with us. He has a phrase saying shadow banking basically is doing the right thing with the wrong method, which basically means the demand and supply is really there. And the repressive financial policies restricting a lot of good businesses that should have happened, but because of the restriction, it didn't happen. So that is also the way I understand what is happening in the FinTech industry, in a sense. So my takeaways from this study, number one, market works. As long as there is a market, there will always be a response to the kind of restrictions in the financial industry, including the interest rate regulation. The second, I think is also quite important, is technology makes a big difference. So curb market always is there, but it never has any systemic implication for the whole banking sector. However, with the digital technology, It is very different now. As Shang-Jin just explained, it grows so rapidly, and the coverage is very widespread, and the kind of the user experience and so on. It was never compared. You can never compare the banks, the financial services with the fintech businesses. And the final point I thought was also quite important. Traditional financial institutions also respond to market competition. Whenever they are under pressure, they are able to innovate. They are able to provide products, more competitive products to the financial market. So this, I thought, is a good case study of financial innovation using the digital technology. I just want to spend a minute or two trying to understand why the deposit rate is so low in China. Low interest rate, especially low real interest rate, is often regarded as an important sign of financial repression, according to McKinnon, Shaw, and so on. But my understanding of the usefulness of low interest rate started with my first job after finishing university in Beijing. My first job was to trying to design some policy reforms for the unified purchase and marketing system in grain sector. And in fact, I spent lots of time in Henan province to conduct a policy experiment. And the unified purchase and marketing system essentially was a state grain department, buying grain from farmers and selling grain in the cities. And the problem we faced at the time when I was involved was the purchase price became so high that the local government had to subsidize. But then the question behind it was really, why was the government doing this? And most people thought the explanation was because grain was such a special product and the government did not trust the market to handle this very important product. And that's why there was a state grain department. My colleague, Song Guoqing, at the time, he was a new graduate from Peking University. I think he studied geology, and so he taught himself economics from a small booklet he bought outside of the south gate of Peking University. But he was a head of a production team in the countryside at the time. So his economics was basically he taught himself, but his analysis of this unified purchase and marketing system was effectively an agricultural tax on farmers and to subsidize the urban industrialization, meaning by setting the grain prices low, they are collecting an effective tax from farmers and selling the grain to the urban industry and the residents at a very low price, which basically is a transfer of fund from farmers to urban industry. That was his analysis, and I thought it was quite insightful. Here, I think there is a parallel story. Why the government continuously maintain low deposit rate in China today? And one of the key reasons is they want to keep the borrowing rate low, the lending rate low, which means you're essentially subsidizing the main borrowers. And in China, the main borrowers traditionally were the SOEs, but now obviously it's much more extensive. So I think the government has been very reluctant in letting go deposit rate regulation. They've been introducing a lot of liberalization, even in interest rate. In late, I think the paper mentioned that in late 2015, the government actually abolished all the restrictions on lending rate and the deposit rate. But we all know even after that, the lending rate was not freely set by banks. The effective implicit regulation is still there. Why? My understanding is, well, I certainly can think of a number of reasons, but number one, they probably still want the lower lending rate, not just for large SOEs, but now they also want low lending rate for the SMEs. The second reason is they also want to create enough profits for the banks Therefore, the banks can absorb the emerging NPL problems. And some of the NPL problems, I must say, are policy induced. And finally, they also want to avoid the so-called excessive financial competition or competition for bank deposits, especially because the banks, the incentive structure is not well reformed yet. The worry is the management might just go for the deposits offering excessively high deposit rate. Eventually, it could cause a financial stability. So this is the background of my understanding for the paper Shang-Jin and his co-authors did. I have three specific questions related to paper. The first thing is about the IV. Shang-Jin just mentioned that they used the two IVs. One is the Alipay penetration rate at the beginning of the period, and the number two was distance from Hangzhou. I mean, I understand these are the things that we try to do. I'm just trying to think about the reliability or effectiveness of these IVs, especially this distance from Hangzhou. Shang-Jin had just showed us some regressions to show that distance was actually a very useful measure, in a predictor for the penetration rate of Alipay or Yueba in different cities. The question I had in mind was distance often is a very useful IV for traditional banking businesses and for traditional trade or other financial activities. But I thought FinTech is somewhat different because FinTech relies on digital technology or internet network that doesn't rely too much on transportation cost or traveling cost. And in fact, what we also find was the beauty or the advantage of FinTech is actually you don't rely on the distances. And today, as we all know, as long as you have a smartphone and as long as you have a mobile signal, anywhere you stay in China, you can almost enjoy the same kind of financial services. And in fact, when I travel around the world and I travel around the country, we do find that you still find that the coastal regions are much more advanced in the so-called digital financial inclusion in different regions. But you also find that the Western regions, the remote areas are catching up very rapidly. So these two maps, what we put together in collaboration with the Ant Group, it just shows the degree of mobile payment development. On the left-hand side, 2011, you can see there was only a very small number of regions quite developed, and the vast of the country was really underdeveloped. But if you look at last year, the 2020 situation, it's a very different story. And in fact, you can find many regions in the middle of the country, in the central China and the western China, are actually quite advanced. And one of the reasons is because traditional financial services are not well developed in these areas. But the FinTech actually filled that gap. So this is the reason led me to wonder if distance really is a good indicator. And if distance is one good indicator, it might be related to something else, because in the early stage, you had more developed the FinTech businesses in the coastal areas, not necessarily because they're closer to Shanghai, but maybe because they have better digital infrastructure and so on. So I'm not saying your IV is wrong, but I'm just thinking, looking at the nature of the FinTech businesses, maybe there's something we can think about, or you can try to convince me more. That's the first point. The second point about the fintech versus bank, and there are lots of different studies, obviously. In this study, as Shang-Jin mentioned, the direct competition for funds or for deposit, that's quite clear. But I think if we look at the relationship between the two, it might be much more complicated. Sometimes we feel they compete with each other, but when we look at deeper into some of the businesses, we may still find that they're in the same area, but they specialize in very different business segments. So one area we've been looking at is the so-called big tech credit. When the big tech credit grows, people think, well, they're competing with the banks. But what we did in terms of analysis, and we find they're actually very different kinds of loans compared to bank loans. And I don't think in the short term, they would directly compete with each other. So for instance, the big tech credit, normally for enterprises or individuals on the platform, very small size, and even the loan size is very small and the duration is very low. And most of them are never covered by banks. And I don't know if many of them would be covered by banks even now. They look like a very different kind of loans. And the big tech credit providers also told us that it's extremely difficult for them to increase the size of loans and to extend the duration of the loans if they just rely on the so-called big data. If they want to offer more normal kind of bank loans, they will need to collaborate with the banks or with from other sources of information. So it's a very different kind of business. And at that point, it reminded me of looking at the discussion this paper has, and I certainly agree. The competition for bank deposits is quite clear. When you have a yuebao and people want to put money into yuebao, and that probably takes some money away from the banks. But on the other hand, whether or not the new products that the banks are offering are competing directly with yuebao, I don't know. Maybe they're competing indirectly, but they might also be different kinds of products. So the so-called Bao products, the same kind of products they're trying to offer. I still feel the kind of customers they attract and the kind of investment they make it's still quite significant. But obviously, offering wealth management products are very useful for these depositors. And so in a way, in that sense, it's a—
Professor Wang?
Yes.
Sorry, 5 minutes left.
Okay. So in that sense, I think this is a competition, but it's not the kind of direct competition for the same kind of products. Finally, the third question, role of the regulation. Why didn't the banks actively offer the money market funds before 2013? The paper offers a number of reasons, and I think they're all credible. But I think that the regulation was probably also a very important reason behind. And many people from the banks told me before yuebao was created, they were not allowed, I'm not sure implicitly or explicitly, to engage in that kind of investment. And to some extent, that was why we saw the emerging, the so-called shadow banking businesses from 2015. I'm not sure if directly related to or not direct or indirectly related to the growing money market funds and related to yuebao. The reason why the money market fund was able to grow yuebao was because Alibaba was an outsider, but equipped with technology in a very different context of long tail and user experiences and so on. So this also relates to the finding of no material financial impact on banks. The banks doing okay, there's no material impact on their financial position. I have a slight doubt about that question. The reason I'm not doubting the result, but I'm just saying The reason there was no material impact was because the regulators basically slowed down expansion of money market fund or stopped the expansion. The Tianhong fund grew so rapidly, within a year, they became the #1 in China and took over the previous #1 Huaxia fund. It took Huaxia 16 years to reach that position, but it took less than 1 year for Tianhong fund to rise to that level. But we know quickly the regulators, they probably didn't stop the expansion, but quickly they told, I think, Ant Group that you should slow down. And later on, I think this practice is probably still in place, that the Alibaba is limiting growth of the yuebao. If you use it, Shang-Jin, you would know it's difficult now to transfer money into yuebao if you reach a certain number. So that's the kind of implicit regulation there. I think it's interesting. I mean, one final point I want to say is it's quite interesting to see the dynamic interaction between regulation and the financial innovation. The paper identifies a number of innovation by the banking sector, but one question remains. With all these de facto liberalization of the interest rate, why didn't the authorities actually take further steps to liberalize the deposit rate? The deposit regulation actually continues. And I think this is an interesting question for us to think about. This is a big part of the overall interaction. So to finish, I like the paper. Very important question, smart implementation and impressive efforts compiling data. The story is also quite straightforward and powerful. I'm not going to repeat that. And I think FinTech and the shadow banking development suggests that maybe interest rate liberalization should not be delayed much further, because if you don't do it, things happening outside of the formal balance sheet. But whether or not the yuebao development causes no concern for financial stability, I think it may need some more thorough assessment. Number one, expansion of yuebao business was effectively limited by the authorities. That might be a reason why we didn't see big impact on banks' balance sheet. But on the second, we know if Shang-Jin was right, that the banks after yuebao start to offer more like wealth management products, market-based products. But we know during the past years, they became a source of financial risks. So this is something we probably should think a bit more. I'll stop here. Thank you.
Okay, thank you, Professor Huang. Shang-Jin, do you want to respond in 20 seconds?
Well, let me thank Yiping for a very thoughtful discussion. First, I agree with the broader storyline is indeed precisely because Ant Financial is an outsider to the existing banking sector. Removing ceiling on deposit interest rate hurts banks, but I think fintech companies do not have the existing interest to protect. That's why it is able to come in and offer the products to compete with this. So the outsider identity, together with the technology, together with the repetition of the big tech payment and market interest rate, this combination give you this bottom-up interest rate liberalization. I also want to point out that there's a difference between removing the former the floor on the lending rate and the ceiling on the deposit rates. The floor on the lending rate was removed by the authorities on their own, and banks don't complain because removing the floor helps to raise bank profits. In contrast, removing the ceiling can potentially hurt the bank profits, and banks resist. That's why having an outsider can help. Of course, banks fight back. We can. My co-author Jiayin found various articles, even at the time 2013, when the banks complain about the problems that the Ant Financial could create for banking sector. It turns out much of the campaign in 2013 were manufactured, didn't have much support. By the time Tianhong Jijin becomes big enough, there's a genuine, one can make a more reasonable case that there could be a financial sector risk associated with a single fund being so large. Therefore, some of the regulation regulating big tech can also be rationalized in the way. But the bottom line is, in response to Yuebao's competition, banks have offered, essentially for the first time, products that pay market interest rates available to households. Today, as a result, Chinese households, can earn market interest rate on most of their deposits. So I think the broad storyline, I very much agree with you. Do I have time to say one thing about the IV comment? Okay, the IV, I think, so the economics about why the question is, Yiping asked, is why should distance matter? So I think the reason is there's a difference between rollover distance in early days of rolling out the FinTech products versus today when you make loans. Today, the marginal cost of the loans does not depend on distance between headquarters of the Ant Financial and the borrower. However, in early days, in order to roll out the products, Ant Financial have to convince, you have to have vendors to sign up on your product. So just having the app available is not enough. To convince a vendor that involves real costs, and they have to do this in batches. So we conjecture that they probably do it in a way it's convenient for them to try to spread out, and we use data to verify this. The conjecture may be wrong. So in the end, it's an empirical question. The data does strongly suggest that they do roll out gradually in that way. I won't be surprised that WeChat finance will do the similar things. It will start from Guangdong and then spread to the rest of the countries.
Okay, I'm going to collect questions for you guys. So any questions from the panel?
Can I ask a question?
Go ahead.
Michael.
And sorry that I also have a question on IB, but my question is on the first one. So you basically use the penetration of Alipay as an IB, but I'm wondering if this IB is actually directly related to bank deposit. So I'm recently actually working with Yiping and Zhiguo on something related. So correct me if I'm wrong, but my impression is actually digital wallet, the money, say online platform users put into their digital pocket, I think is highly correlated with how much money they want to spend on the platform. So it's almost like a cash in advance story. So that connection leads to kind of a direct relationship between, say, Ali penetration or the size of online platform with, say, the money you want to move from bank deposits to your digital wallet. So that might create a concern for your first IB. But I could be wrong. I want to hear your thoughts on this.
I guess the question is, I guess I'm trying to formulate your question in terms of econometrics. You're saying that places where people have greater need to do online shopping are places where people want to transfer more money into digital wallet. Is that
yes. Exactly.
the idea? Okay. And in what sense that's a problem?
Well, then this IB is directly.
You say people take money out of the product because of
right.
not
because of FinTech.
Because of a need to buy stuff. You say okay.
Right.
So you might think maybe so having a couple of answers. One answer is having two IV could be helpful. So to the extent distance to Hangzhou need not be correlated with the consumption need. That could be one answer. The other is you know, Alipay has been around for a long time, and you can do, if you look at the growth of deposits correlated with Alipay before 2013, you see no correlation. So it is the you know, sort of the emergence of a Yuebao that gave you this regional variation in loss of deposits bank by bank.
Okay. Do you have a question?
Yes.
Hi, Jun.
You need to unmute yourself.
I
Good.
know.
Now it's good.
Is it good? Can you hear me okay? Or?
Yes.
Okay, good. I'm having some computing issues. Shang-Jin, interesting paper. So since we are I didn't want to talk about the IV since we are discussing the IV. So in our paper, in my paper with Xiaomeng and Claire, we also use distance to Hangzhou as an instrument. The logic is that it's really the offline usage of Alipay that is meaningful, meaningfully connected to the distance to Hangzhou. So I wonder, the usage of Yuebao, it's, as Yiping said, it's mostly online. So, and the Yuebao, the source of Yuebao intake probably is related to the online spending rather than offline spending. So I feel that in that sense, maybe distance is not that meaningful here, relative to the offline usage that we think is the connection. This is one. Second, in relating to Michael's comment, maybe distance to Hangzhou is just distance to a more affluent area in Shanghai, in China. So we actually have a radius to capture that distance, meaning that within, let's say, 500 kilometers of Shanghai, then the distance to Hangzhou and distance to Shanghai, which probably is a better proxy of affluency, that distance becomes more meaningful. So maybe you could do something like that as well. So within a 500 kilometer distance.
So we direct, sorry, pardon me, you have not finished it, but please finish.
No, I'm gonna actually have a question a separate question to ask. So please go ahead.
Oh, so we directly control for local affluence level by per capita income. So we have a direct control for that. And then my explanation for distance from Hangzhou is very much linked to your offline story. So they are linking the maybe I didn't use this term, but I say the rolling out has to have a geographic feature, precisely because in order to bring vendors, including offline vendors, to subscribe to M Financial have to negotiate with people, with vendors, a group of vendors, right? And this makes it impossible for it to roll out nationally overnight. So you have to do this region by region. It can, and in its outreach strategy, apparently geography plays a role. I mean, it makes sense. That's a cost-saving way to roll out in a way that has this geographic feature. So the offline vendor is part of a story that the offline vendor gives you the geographic features. As a result, of course, people can only access Yuebao once they have Alipay. People will only sign up Alipay to the extent it's used for both online and offline. So it's consistent with your story, I think.
Okay. Shang-Jin, you have
one more
question.
question.
You have a question?
Jun has a question. Jun has a real question now.
Yeah, that's a real. So I was very intrigued by Yiping's discussion. So let me pick just one, the connection between FinTech and the bank. So I thought what's really interesting probably is not Yuebao competing with deposit. It's really the presence of the wealth management product. I wonder if you have additional insight on how Yuebao's presence or the rise of the Yuebao really push the banks to do more wealth management product or doing wealth management product online. Is there a link there, Yiping?
Yiping is, yes.
Well, I don't know, but just look at the timeline. The surge of the so-called shadow banking really also started after 2013. And just following what Shang-Jin was telling us, if banks are also offering the same kind of products, banks' comparative advantage is not the kind of like a money market fund, because the reason why Europe attracts so many people investing is the extremely low transaction cost. And you can just do it like instantaneously on your mobile phone. I don't think the banks had the same kind of technological equipment, but the kind of wealth management products they provide certainly became very attractive. And Europe was extremely successful, and partly because it's accidental. In June 2013, when they rolled out the product, there was a kind of a money market crisis at the time. So the overnight rate reached almost 7–8%. So the return on Europe suddenly became so attractive, and people suddenly just, it's kind of like a commercial campaign for Europe, and suddenly they attract lots of people.
Yeah,
but
that shows up on my graph too. Yeah. So my graph supports what you said. Yeah.
Right.
But even without that interest rate spike, of course, the SHIBOR rate is always much higher than the deposit ceiling.
Shang-Jin, my point was it's kind of like a commercial for Europe, suddenly advertisement, and the people all got attracted. But I think in that regard, wealth management products could also be regarded as kind of a response to the money market fund development. I think these are more in a bank's advantage of providing these funds. But then we are seeing there are also problems there. This is why I said Shang-Jin may want to take a bit closer about the risk implications.
Okay, I have to tell you guys, there are many questions in the Q&A box. Shang-Jin, you need to, do you see it?
Would you like to pick some questions for me, or you want me to take a look at?
Why don't you pick? You can see it, and you can pick. So the first three already addressed.
So, is there a particular question you think I should address?
Up to you. So there are 9 questions, 9 comments. So the first question from Gunter Durfrey is already addressed. So you move on. Type of assets held by Chinese money market funds.
Okay. Yeah, so you said that's already been addressed, right? Oh, you mean it's a money market fund. So they buy what typical assets that money market fund buys, short-term government bonds and high quality commercial bonds.
Okay, so the typical money market fund. So the next question, Eurobond is basically providing MMF without binding by the reserve ratio requirements. The deposit ceiling was removed during the course of interest rate marketization, not due to Eurobond. Simply compare the size of demand deposit of commercial banks and that of Eurobond will do the job. Well, that's a comment. So
we disagree with this statement a little bit. So our argument is that once after Eurobond is introduced, banks have to respond to that to defend their money. So Eurobond is not able, however fast Eurobond is growing, as Yiping was pointing out, the Eurobond / Tianhong became the world's largest money market fund, still not large enough to compare to Chinese banking sector's deposits. But part of the reason why Eurobond wasn't even larger was because banks have done something to protect their funding sources. The action of the banks essentially offer market interest rate to households. That reduces the need for households to move even more money out of the banking sector. It also reduces the bank's need to defend interest rate ceiling, because most of the funding now are no longer most of the money flow into the banking sector are no longer being paid this very low interest rate. So suddenly the bank incentive to very strongly defend interest rate ceiling is also gone. So for that reason, we think we think it's not coincidental that within 2 years the deposit ceiling formally is removed as well.
Okay, I have 2 minutes left. And then for Li Ran's question, if if serving SOE cheaply is one motivation behind deposit rate ceiling, testing theories of local city level SOEs served by traditional banks may provide some insights to this theory. Yeah, you haven't done that, right? But you can.
I didn't understand that. What is it? So
the question by Li Ran, do you see it? If serving SOE cheaply.
The question is whether is the suggestion that the relative importance of SOE in a city plays a role in interest rate liberalization or not? Is that a question?
You can compare your results for city level SOEs.
Yeah, we can. Is there like is another regressor, which is to measure city level SOE importance city by city and see whether that plays a role in the we can.
Okay. Last question, okay? For the rest, please directly email Professor Wei. So last question by Joe. Joe said, Bernie and I organized a forum in Shanghai 2012 where less regulated shadow banking products were the rage in China. One panelist, Anthony Neal of Hong Kong, mentioned it reminded him of the lead-in to the GFC global financial crisis as a now crisis of the US. Are we seeing a repeat of all of this through these fintech wealth management financial products?
So I did the comment. So both Yiping and Jing mentioned about wealth management products. My understanding is that common usage of the word wealth management products includes both bulk type of products as well as non-bulk products. These actually are different in our view. What Yuebao has triggered is many more banks offering bulk type of products directly, right? So that we demonstrate that the timing of banks rolling out this can be linked to bank level exposure to this. Now the wealth, but for Yuebao, what the Alipay does or Ant Financial does is that after the success of Yuebao, of course, now they get into mutual fund business, something that Jing has studied and Jiayin, you have studied. The mutual fund investment also expose Chinese households to a much richer menu of investment. I think the mutual fund investment broadly has triggered second round of bank response. Now they have to offer many more wealth management products to protect essentially their funding sources against the competition from mutual fund investment. But I want to say, in fact, that Yuebao is also an investor education tool that for the first time introduced Chinese households to the concept of mutual fund investment, not just money market fund investment. I have a graph that showed that previously, most Chinese households had zero investment in any mutual fund product. Yuebao was essentially the very first mutual fund product they invested, and then they get comfortable with this. Now they are willing to invest in many more mutual fund products. That triggers a bank to respond by offering many more wealth management products. There could be financial stability concern. Indeed, is useful to have a more careful study on this.
Yeah, actually, I would like to raise a point about financial stability. First, I want to thank. Do I have time, Xiaoyan?
I'll give you 60 seconds extension. That's the last one.
That is going to be tough. Okay, give me 2 minutes instead of 1 minute. Okay, what we have right now is really that the market always finds some way to optimize. So they will start with catering the uncatered and then deal with those constraints. And then there will be the new products competing with the old products, et cetera, et cetera. And also all these things trace through the growth in finance literacy and the development in China. This is what the past from 2000 to now is about. One thing that reminds me is that when this kind of innovations happen, there will be some impact on our monetary stability and financial stability. It's because the outcome variable and your target regulating variables change in their relationship. The introduction of money market mutual fund changed the money demand equation. The introduction of all these products changed the relationship between the bank balance sheet and the final outcome at the end, the financial stability. So in spite of Shang-Jin's results that in those days there were no impact on the bank's risk taking and so on and so forth. But I think that's not the overall picture. I wonder, what are our concerns at this point, given all these products, given that the relationship between the outcome variable and the regulated variables keep on changing, and you have to look at more and more variables. So any comment on this question?
I mean, I can start first. I'm happy to hear others' view on this. I mean, fintech development, it brings a lot of changes, as you are pointing out. Some of them can very well lead to financial stability concern that requires careful studies. In response to suspending Ant Financial's IPO, the draft regulation points out a few very concrete stuff. So for example, one of the things is that when Ant Financial make loans, a subject that Yiping has studied, because Ant Financial's own cost of funding is very high. It relies on ABS as a source of funding, much higher than bank funding sources. Ant Financial works with banks. Essentially, I provide the algorithm. I mean, Ant Financial. I provide the algorithm in a credit score method. You provide funding. We combine to make loans to borrowers. Regulators are very concerned because they think if Ant Financial doesn't have much skin in the game, it may not be. What if it makes a mistake in making a credit risk judgment? And banks do not have the way to directly do due diligence. They have to rely on a technology company to do diligence. What if could the banks get into trouble without realizing they got into trouble? So that kind of a concern. So far, the data Huang and Yiping and others have shown seems to suggest that big tech's risk scoring algorithm seems to work very well in sample so far. The unknown, of course, is when a big shock comes. Is it possible that the algorithm that works well during the normal time does not work very well, and therefore allowing banks to make loans using some other firm's sort of due diligence credit scoring algorithm could be a potential source of concern, and the regulators' current attitude is to be super conservative. Whether the regulators get it right or not, we do not know, because we don't really have good study, good information on this. That calls for more support for research, I guess.
Can I add just one sentence? Because Shang-Jin pointed to made a point that most regulators and economists ask us about this sustainability of big data credit analysis assessment approach. I mean, I share the concern. But if you look at what happened last year, pandemic was probably one of the biggest shocks that we have seen in recent history. But you look at the NPL ratio for the WE Bank and my bank, they all use a similar approach. Their NPL ratio peaked around the summer in July and August and start to come down. Now it's in a more normal range. And the bank's NPL ratio is yet to start because they have this so-called rolling over policy from the government. So I'm not saying there is already a definite conclusion yet, but I think one possibility is big tech credit actually utilizes the big data. They're much more flexible and can adjust their models much more quickly. And also their loans are much in shorter duration, like 3 months, 6 months. So they're actually able to adjust their model and assessment quite quickly. They respond to the shocks more effectively. That's my preliminary takeaway.
All right. I'll give myself 20 seconds to say 5 sentences. I think for fintech innovations, if we're talking about the equilibrium, there are several players. We have the technology, we have the investors, we have the firms, we also have the regulators. So when the technology is bringing so much significant improvements, the regulators and the whole society will be watching it and see how much improvement it can bring to us. But then if it's good, it will survive. If it's not good, the regulators will jump in and shut it down. Like you guys are mentioning the positive innovations, and past few years, we saw that P2P industry was under a lot of regulations because there are a lot of downside risks. So that's, to me, regulators, there is a cycle to consider as well. Now it's 11:20, I have to end it. So Shang-Jin, you can see all those questions in the, or maybe the ABFER staff can send you those questions. I'm sorry for Yongxiang and Nan and Tom. Please directly ask Professor Wei if you have further questions, or Shang-Jin, you can directly address them. I am very grateful for this very exciting paper and excellent discussion and the heated discussion afterwards. So I'm gonna call, this is the end of it. This is the conclusion. I'll see you guys in 2 weeks.
Thank you. Thank you.
Thank
to
you. Thank you,
Jiayin,
everyone.
To Shang-Jin,
Yeah.
to Yiping. This is wonderful. We learn a lot.
Do email
very
me questions.
stimulating.
Yeah, thank you.
Yeah. I just want to remind everyone that next round, because North America will adjust the clock, so they will start 1 hour earlier. But for us, it's the same hour. Okay.
Okay, cool.
Bye.
See you guys.
Thank
Bye-bye.
you. Bye.
Excellent.
Thank you,
Thanks.
everyone.